Hello and welcome to Money Matters TV. I'm Mike Dever, founder and CEO of Brandywine Asset Management. And my guest today is Vahan Janjigian, PhD and Chief Investment Officer of Greenwich Wealth Management. Hello, Vahan.
Hi, Mike. How are you?
Hey, doing great, thank you. Um, so I saw you just had a recent stint interview on CNBC, and the question that was asked of you early on was about froth in the market, or is it overheated? And you came back with a really nice analogy, I thought, of Nvidia, which was brought up. How can it not be? And Cisco back in the dot-com era. And yeah, if you could just kind of relate a little bit, what's your feeling on where the market is today? Is it overvalued, and how does it relate back to then?
Yeah, so I do believe the market is overvalued, especially certain sectors of the market. As you know, one of the hottest things right now is artificial intelligence, and uh, any stock or a company that's AI related has been going through the roof. In fact, most large tech companies have really been doing extremely well and outperforming the markets. And part of that is because when people look at the market, they tend to look at something like the S&P 500. And even though there are 500 companies in that index, the top 10 companies alone account for over 40% of the index, and they're all dominated by these large cap tech companies. So, yes, I'm concerned the market's overvalued. Nvidia right now is one of the hottest stocks in the market. It's got a market cap of well over $4 trillion now, which is almost hard to believe. And my view is that AI is a real thing, and Nvidia is a real company with strong profits, and I have no doubt that those profits will grow. I think its business will do really well. But I always remind myself of what happened in the late 1990s. Back then, the hot thing was the internet. And Cisco Systems was the hottest stock in the market. And that stock kept going higher and higher and higher from 1994 to 2000, where it peaked. It was up sixfold. And then in 1 year alone, it fell by 90%. And if you look at Cisco today, it's still a great company. It still has, strong earnings. In fact, they have record earnings. They're still one of the best companies in the internet area, but the stock is now 50% lower than it was at its peak in 2000. So if you bought it back then, you still haven't even broke even yet. So my
Uh,
expectation is that some of these AI stocks will, continue to do well as far as their business is concerned, but that the stocks are overvalued. I'd be very hesitant to buy them at today's prices.
okay, what you see out there is everybody in this land rush, right? These companies, XAI and Anthropic and OpenAI, and to get this mind share and as much traffic and visitors as they possibly can, similar to the dot com. And you've got the VCs and other private money that's just more than willing to fund it, the build out. But at some point, they need to get a return on that. And it seems like the industry size has to become so substantial to give a payback on these investments. I mean, is that correct? Can they all these survive and thrive, or will you end up with a handful or one or two that end up dominating in this AI space?
Well, no, I don't think all of them will survive, but I do think there will be some companies that will do well that aren't even in existence yet. Again, Cisco is a good example. Cisco today competes against companies that didn't exist in the 1990s, and some of those companies were started by former Cisco employees. So I have no doubt that we'll see new companies in the AI space, and I have no doubt that a lot of money will be made. My only hesitation is that I think today's stock prices take that into account. In fact, take it more into account. So I'd be hesitant to buy. And I would also, warn people that, many investors, like to buy individual stocks, and there's nothing wrong with that. But many investors also own diversified mutual funds and ETFs, and they think they're very diversified, but again, they're very heavily weighted toward a small number of stocks. So I used to own Nvidia in my clients' portfolios, and I had to sell it because my clients also owned ETFs and mutual funds, and Nvidia is the largest component of those things. So I always warn investors that look, if you have a substantial position in Nvidia or Microsoft or Apple or Meta or something like that, and you also own ETFs, your exposure is probably much greater than you think. So you need to be very careful.
Yeah, and if you had any exposure, you now have a substantial exposure just because of the appreciation. It's been so dramatic.
That's
So,
right.
so what would you recommend for someone that has maybe S&P exposure, 40% in the top 10 names? It, there's equal weighted indexes. Does that make sense? Does over something like a cap weighted index?
Yes, they do. So SPY, for example, is the most popular index that tracks the S&P 500. But there's also an ETF called RSP, which is the Standard and Poor's 500 on an equally weighted basis. And I think that's something worth considering, especially if you have a lot of exposure to these large cap stocks. But I think a lot of investors have also ignored the mid cap and the small cap areas as well. So there are plenty of ETFs that track mid cap stocks, small cap stocks, and you need exposure to that. And I'd also point out that most Americans have very little exposure to international markets. So you should focus on getting some exposure to international markets. And again, the best way to do that is through ETFs or mutual funds. I personally find it too difficult to pick non-American stocks, primarily because there isn't as much information readily available about them. You can't, very carefully go through their financials like you can with American stocks that are required to file very detailed information with the SEC. So for international exposure, I would recommend ETFs.
Okay, you're so right about the concentration with the domestic. In my book I wrote over a decade ago, I had a chapter that was focused on this home team advantage, and it talked about started with sports teams. In my analogy, I was saying if you go around to a game between the Eagles and the Giants, and it's Giant Stadium, and you ask who's going to win, well, it's the Giants. The exact same game played in Philly, 90% of the people are saying Philadelphia because they want it to be their home team.
Right.
And the same thing applied when I did the research on it to not just individuals, but institutional investors who had predominant home team focus in their investments. And it was kind of unusual in my mind, who I'm just sort of agnostic and looking for what is my best opportunities, to think that they exclude some of these great opportunities in other places because of the fact that they didn't live there. And you had this home team bias in the markets. But some of the things you're talking about here with the small caps and other markets that have been maybe neglected, that kind of leads into a viewer question that we have. This one comes from Jeff Waldron in Boston. It's, what are some safe investments in time of uncertainty? My answer to that, and I'd love to get your answer as well, but my answer to that is that what is considered safe? And I've had so many people over the years that have told me that they just want to do something that's safe and they don't want to take any risk, and they put it into cash when cash was earning less than 1%, and inflation's running at 2 or 3%. So you're essentially locked in a guaranteed loss annually with that investment. That to me doesn't sound safe. And at some point, you need money to live on in retirement or for other expenses or vacation, whatever it is you want to have. And if you're not earning that money, that's that's the risk, not losing money. It's not having the money you need to live on is maybe the greater risk than losing the money. And I'd love to hear your view on that. And then what can they do? Because there's always uncertainty.
Yeah, so clearly the safest investment is to buy treasury securities. In fact, in finance theory, we typically call treasury securities the risk-free investment. And these days you can get a reasonable rate of return close to 4%, for example, on Treasury bills. I don't know how much longer that'll last if the Fed cuts interest rates again. But that's the safest. But as you point out, if you lock yourself in at a rate of return like that for a long period of time, and then we have inflation, then you're actually losing money because you're making less than inflation. So one very important concept to remember from finance theory is the risk return trade-off. There is a trade-off between risk and expected return, not actual return, but expected return. So if you hope to make a decent return on your portfolio over time, you have to take some risk. And what that means is that you need to have things like stocks in your portfolio. If you don't want to take any risk at all, then you have to settle for a very low rate of return, which right now is about 4%.
Right. Okay. So yeah, kind of you get back to that conundrum again. It's that it might be safe in that you have less chance of losing your money, but it might be risky and you have less chance of actually meeting the needs that your portfolio is supposed to be producing for you, right?
Yeah, and it's also very important, keep inflation in mind, because even if you're making money, or it looks like you're making money, you might actually be losing money if you're making less than inflation.
Correct. Exactly. Okay. Now, you mentioned something in that response about the Fed and cutting interest rates. And what's your view on that? I mean, the Fed has started a year ago. They had a big pause, cutting interest rates, and they've had a couple cuts now to the short-term rates. What do you expect, and what's that going to cause to happen in the markets, in the environment, economy? What do you see?
So I think the Fed's in a very difficult place because on the one hand, there appears to be no need to cut interest rates any further because we have a situation where the economy is actually doing pretty well. So there's really no need for the Fed to be boosting the economy. But on the other hand, there are some concerns about the employment market. So we do have a weakening of employment recently, especially for recent college grads. Their unemployment rate was up to 9.3% in August. We don't have more recent numbers because of the government shutdown, but there is a concern that employment is continuing to weaken. The last ADP report actually saw a loss in non-farm payrolls. So I think there is, reason for the Fed to continue easing a bit. And I will point out that they actually are starting to ease, not just by cutting the Fed funds rate, but they're also easing on the long end of the yield curve through their open market operations. So the Fed has a balance sheet which had reached, almost $9 trillion in 2022. And they've been reducing the size of the balance sheet, which is actually a form of tightening monetary policy. But Chairman Powell recently said that this is going to come to an end soon. So it looks like they're also going to be easing on the long end. So my view is that, I think the Fed perhaps should cut a little bit more, but they need to be careful because we still have inflation higher than their target, and there is some evidence that the tariffs are finally starting to affect prices, and that we could have even more inflation. So it's a difficult decision for the Fed.
Yeah, explain that a little bit. You're talking about the Fed balance sheet and $9 trillion and how that's tightening and short end of the curve, long end of the curve. I think our viewers have heard the term quantitative easing. You're talking about quantitative tightening. Exactly how does that work and how does that affect interest rates in the economy?
So quantitative easing basically means that the Fed was increasing the size of its balance sheet by buying all kinds of securities, including treasuries, mortgage-backed securities, and stuff like that. When they do that, they're actually flooding the market with money. So this is a form of easing that should bring interest rates down. But the balance sheet got so big, there were a lot of concerns about that. So the Fed decided that they needed to reduce the balance sheet, which means that they do the opposite. Instead of buying bonds, they could sell bonds, but in this case, they weren't actually selling. They were just not buying more bonds when the bonds they had matured. And so that allowed the balance sheet to decrease. And this is kind of like taking money out of the economy. So it's a form of tightening. And when we see tightening on the long end with easing on the short end, the yield curve should start normalizing, which means that it should start becoming more upward sloping. And that's what's happened. We now have an upward sloping yield curve, which is typically considered a good thing. And it could be an indication that the economy will continue to do well. But the Fed, could change its mind any day and do something different. Right now, there are a lot of concerns that the Fed's independence is on the line because President Trump has been pushing the Fed to lower interest rates. In my view, they should have lowered interest rates a little bit sooner. But if they start lowering rates only because the president is pressuring them to do so, that brings their independence into question. And I think it's very important that the Federal Reserve remain independent and make the decisions that are best for the economy and not decisions that might be, good for a political reason.
Right. And we've seen plenty of countries where they did not have independent central banks and the governments helping guide the monetary policy and interest rates. And the error is always on the side of inflation.
Correct.
It's always better for these countries and their leaders to, in the short term, boost the economy, flood it with money, and inflation comes around eventually because you got that amount of money chasing the same amount of goods and services, and that's going to drive those prices up. So I see that happening all the time in other countries. It'd be a shame if we lost the independence of the Fed here and started having that same type of behavior. You mentioned tariffs earlier. How do you see tariffs affecting what's going on in the economy and inflation? You also mentioned you thought Fed started easing a little late, but at the same time, you acknowledge that inflation's running hotter than the Fed's target. So, how can you kind of rationalize cutting rates with the inflation over target, with tariffs, Fed independence? How does it all come together, and what might happen here?
So my view was that there was evidence growing, for quite some time that the employment market was weakening, and that inflation was under control. It wasn't at the 2% target, but it was low enough that, given the weak employment market, I felt that the Fed should start reducing rates. However, tariffs have the potential of causing inflation to go up much higher. So when President Trump announced the tariffs on Liberation Day on April 2nd, I was very concerned that the tariffs that he announced were going to be too high and cause a tremendous amount of inflation. Now, as you know, he's walked back some of those tariffs, but in general, I don't think tariffs are actually a good idea. I think targeted tariffs make sense. Like, for example, when it comes to issues that involve national security, I think tariffs could be useful there. But across the board, tariffs like, 100% on one country or 20% on another country, I don't think that's in the best interest of the United States because, there's a concept in economics that basically says that every country should produce what it's best at and trade with other countries. This is the law of comparative advantage. All countries are better off if we have no tariffs and people and countries are able to trade with each other. Again, tariffs might make sense for national security purposes, but otherwise they're a friction on the economy and they could reduce global economic growth. So as a free market capitalist, I am opposed to tariffs in general. And I do believe that the level of tariffs we have now could cause inflation.
I I also feel like the tariffs that we have are a highly regressive form of tax. I mean, does that seem right to you that people paying for it are the people are consuming a majority of their income is going to consumption to live? The rich people, yeah, they're not spending as much. The tariffs maybe don't impact them as much. Is that a valid concern?
Well, we do have other regressive taxes. For example, there's tax on gasoline, and when anybody goes to buy gasoline, they're paying that tax, and that's a bigger proportion of a person who has lower income than for a wealthier person. Most states have sales taxes. You can argue that's a regressive tax too. Europe has the VAT tax, which you can argue is regressive. So regressive taxes aren't unusual, but in the United States, we counter them with the income tax, which is quite progressive. The more you make, the higher the tax you pay. So yes, tariffs are a form of sales tax. They are a tax, and they're a form of a sales tax. So you could argue it's regressive.
The other thing that tariffs, I think, caused, I put a little, as you kind of point out, some friction in trade, but it's also put some friction, interfered with the multinational relationships. And we used to have a lot of our debt bought by other countries, the sovereign debt of the United States. Are you seeing changes in that now? And is that at risk with tariffs against these other countries?
Yeah, that's a very, very good point because what we've seen is global central banks have been selling U.S. Treasuries ever since April 2nd when those tariffs were announced. It's a form of decoupling from the United States and the U.S. dollar. And they've been using the money when they sell those treasuries. They've been using the money to buy gold, and that's one of the reasons we've seen, gold prices go through the roof. So what's interesting that, kind of perplexing to me is that even though they're selling treasuries, which basically means there are more treasuries available on the market, interest rates went up only temporarily and then they came back down again. You would expect interest rates to go higher if these foreign governments are now flooding the market with U.S. treasuries because investors will demand a higher rate of return in order to buy those treasuries. So it is a little inconsistent and perplexing as to why long-term interest rates have come down, so much since the start of the year. I don't expect that to last, so I would be a little careful about locking myself into, let's say, a 10-year bond because I do expect those interest rates to reverse.
Yeah, what would you think? How do you explain that? That's a great point because when Liberation Day hit in early August and or April, and we had the tariffs, you know, initially get imposed, everybody was talking about the bond vigilantes that came in and just drove interest rates higher to the point of panic, where the government said, "Okay, we're going to back down a little bit on these tariffs." Bond rates came in a little bit. The bond market sort of stabilized. What caused that? And then here we are today with tariffs across the board that are multiples of what they had been previous to Liberation Day. I'll put that in quotes, right? Liberation Day, but interest rates now are 0.5% or more below where they peaked then.
Yeah, I think part of it is explained by optimism on the part of investors that the tariffs that we have currently are not going to stand. That Trump is basically using them as a negotiating tactic, and that we've seen many times, for example, that he announces a very high tariff, and then he has a meeting with the leaders of a particular country, and those tariffs are dramatically reduced. So I think the market believes that, over the course of the next year or so, many of these tariffs will be reduced. And remember, they are being challenged in court, so it's not even clear that many of these tariffs will stand. So I think investors are being optimistic, perhaps a little too optimistic that these tariffs will be reduced, and that's why they're willing to push interest rates lower. My view is that even if we see lower tariffs, the current reduction in long-term interest rates will probably reverse. I think because of the amount of treasuries that are now in the market, and the fact that the U.S. government continues to increase its debt and has to finance that debt, more and more treasuries will be coming into the market, and investors will eventually say, okay, I'll buy those treasuries, but only at a higher interest rate.
Do you see that even in the face of the Fed loosening and lowering interest rates? We would have interest rates go up?
Well, yes. So again, there's a difference between the short term and the long term. So the Fed can very easily affect the short term interest rates through the Fed funds rate. So I do expect the Fed funds rate to come lower. So the interest rate on 1 month T bills, for example, should also come down. But on the other hand, the Fed does not have as much control on the longer end. As I mentioned earlier, they do have these open market operations they use. They have the balance sheet that they can increase or decrease, but that doesn't impact interest rates as much as their direct involvement on the short end. So it's more difficult for the Fed to control long-term rates. They are much more controlled by institutional and individual investors in the market.
If they do see the short-term rates dropping and a rise in long-term rates, obviously we're steepening the yield curve. What does that bode for economic growth or inflation? Any of those kind of metrics?
So the yield curve is usually upward sloping. It's not always upward sloping, as we've seen in the recent past. We had a downward sloping yield curve, or we had a flat yield curve. But I would say 70% of the time, if you go back in history, the yield curve is typically upward sloping, and an upward sloping yield curve is considered to be consistent with an economy that's expected to grow. So if you are worried about a recession, sometimes the yield curve can give you a tip off that a recession is coming by changing its slope from going from upward sloping to flat or downward sloping. So
And we had those warnings for like 2-3 years running that we inverted yield curve, we're getting ready for recession, that just never materialized. Yeah.
excuse me. Yes, you're right. So it's not a perfect predictor, just like the stock market is not a perfect predictor of a recession. But sometimes they can tell you what investors are thinking. So they can tell you that investors are expecting a recession, even if that recession never materializes.
Okay. So we got just another minute or so here to wrap this up. And in general, we've covered everything with the Fed and interest rates, tariffs. Do you see anything that's of like a heavy warning right now in any of these signs that would, I know you say things are frothy or overpriced, that would make you do something more dramatic as far as with investments in your portfolio? Are there things you're buying today that you think take advantage of this situation?
Well, one thing I have been doing is I have been trimming some of my positions, including, some of the ETFs that are exposed to the S&P 500 or the Nasdaq, because as I mentioned, I do think the market is pretty high. So I've been trimming those positions, and I'm more interested in going into areas that I think are undervalued, perhaps value stocks. Or even international stocks, although international stocks have done very well year to date.
Yeah.
So I would be hesitant to go into growth right now, and I'm more interested in stocks that have good dividends, growing dividends, and provide value. They're not too expensive.
Very good. Well, thank you very much, Van. It was great talking with you. You've got lots of insights, lots of knowledge. You really appreciate that. Our next guest on Money Matters TV is Marina Katz of Katz Jameson and Associates. Thank you for watching Money Matters TV, where your money matters. See you next time.